Adjunct Professor Moran, Macroeconomics, Factors of Production. Factors of production are also known as resources. They are what are used to produce either goods or services or capital goods. There are four factors of production. The first is labor, also known as human resources. Each factor of production is paid with something, and to economists, labor is paid with a wage. Doesn't matter what an accountant calls it. Salary, bonus, whatever. They're all called wages to an economist. It's all paid work of a routine nature. And the scarcity of labor is measured by its wage. The more scarce, the higher the wage. The second natural resource is land/natural resources. It's said to be paid with rental income. Rent doesn't mean to an economist what it means to a layperson. To an average person, rent is what you pay on a rental apartment. But to an economist, rent is something that is paid when price doesn't work. So, for example, let's take supply and demand, price, quantity. At a low price, not a lot of quantity will be made. At a high price, more quantity will be made. Price is a signal to producers to make more of something when the price goes up or less of something when the price goes down. However, there are times when this cannot happen. Price, quantity, supply. No matter what the price, the same quantity will prevail. This is no longer called a price. This is called a rent. When the price quantity signal breaks down, then price is no longer called price, it's called a rent. And so natural resources are things that are limited in supply and don't respond to changes in price. Mark Twain once said, buy land, it's the only thing they're not making more of, and that's why the payment for land is said to be rent. These are natural resources: soil, minerals, animals, timber, undeveloped land. There are two types, renewable and non-renewable. Renewable are able to be restocked, so plants, animals. Non-renewable, once they consume, they're gone forever, like mineral ores, oil in the ground, for example, iron ore. Now, another natural resource is capital resources. These are man-made things that are used to produce other things. And these capital resources can either be used to produce goods and services or more capital resources. This is like an assembly line, for example. Capital resources are depreciated. Depreciation is an accounting entry that charges the cost of a good over its expected useful life. Many assets, things businesses buy, last more than 1 year. When it lasts more than 1 year, an asset must be depreciated. Let's take an example of a pizza delivery company. Let's say I want to go into pizza delivery, and I decide that it will be more efficient if I buy a car to deliver my pizza so it's not cold and greasy by the time I get it there. I buy a car, I cash account it, I do not depreciate it. What this looks to an investor is, in year one, I bought the car, I sold $20,000 of pizza delivery, and it cost me $20,000 for the car, and I have zero profit. Sales minus cost equals profit. In the first year, I look like an idiot. In the second year, I still sold $20,000 of pizza delivery, but since I paid for my car in the first year, I have no cost in the second year, and my profit now is $20,000. I look like a genius. Let's assume the car lasts 5 years. 20, 20, 20, 20, 20. I deliver $20,000 of pizza every year. I pay for it in the first year. I have no expenses next year's. And so I look like an idiot this year and a genius in these years. This is not allowable to be shown to investors in a publicly traded company. There's a group called FASB, and they promulgate something called GAAP, Generally Accepted Accounting Principles. And this is an income statement. When you have an income statement and you release it to the public, you have to depreciate an asset that is bought that lasts for more than a year. You take the useful life of the asset, 1 through 5 in this example, divide the price of the asset by its useful life. 20 divided by 5 is 4, and you have to charge the income that asset generates for the cost. So each year I deliver $20,000 worth of pizza, and I use 1/5 of a car. That gives me a $16,000 profit, and this really is what happened. I generated $20,000 profit with 1/5 of a car, and got $16,000. Now this depreciation entry is really just a phony baloney bookkeeping entry. There is no $4,000 being spent here. There's another statement that is shown to the investing public called the cash flow statement, and in that statement you can show $20,000. But on an income statement you have to have this completely phony baloney bookkeeping entry. The cost that you actually paid 1 year is divided by the life of the asset, in this case 5. Turns out 4. I generated $20,000 of sales using 1/5 of the car, earning a profit of $16,000. Now, I'm not going to ask you to depreciate anything, but you need to know that capital goods are depreciated. Important to society is the concept called capital formation. Capital formation is the idea that society needs to set a portion of income aside as savings. That's because capital goods are often expensive. Businesses may go to financial markets to borrow money, and those financial markets need to have it to loan it to them. This way society is more productive because the production of goods and services, the capital, is more efficient than producing by hand. So how can we encourage society to save money so it is there when businesses need to borrow it? And that encouragement by society is called capital formation. The last factor of production is entrepreneurship. Entrepreneurship is said to be paid with profit and loss. By the way, capital is said to be paid with interest because often capital goods are expensive and businesses borrow for it, and interest is paid on borrowed money. But entrepreneurship, the payment for entrepreneurship, is said to be profit or loss. It is a talent or skill that people have to search out and take advantage of new business opportunities. These people are risk takers. They combine the factors of production in new and different ways. They put their capital at stake, their money at stake, in this case using capital as an accounting term. They put their money at stake, and if they guess correctly, they get a profit. But if they guess incorrectly, they will get a loss. There'll be a file posted that will show various factors of production around our community. And you can open that file and then try to guess which one is which factor of production.